Okay guys, so let's talk about Nike, because Nike it's a great company who has fallen a lot from like 170 to like $75, and people are asking, okay, should I invest in this company? So the thing is that we have to look at Nike a bit differently because it's a cyclical company. At least this is how I see it. It's a cyclical company. It's out of cycle right now. So of course it's not performing. The economy is not great in the US and worldwide, even though companies are going well, and I'm just referring to technology companies, not all of them are well. People don't have money. The shit is hitting the fan in a way or another. And Nike is reflecting that because Nike has had a poor revenue growth, and of course people are afraid their guidance has been reduced. And is it worth it investing in this company? I think yes, and I'll show you why. Because Nike is in a very strong position, and let's look a bit at the numbers. Okay, of course you can look at valuations and blah 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 blah. No one gives a damn about them. Okay, they're important, but let's say they're not the most important things that you look at. You don't look at the PE ratio of a company and just that, or the 4 PE, because PE ratio is the situation or the picture of a company right now. You're not investing in a company for what it is now, you're investing in a company for what it will be. And of course, if you're looking at PE ratio, it's looking good. Like a 20 PE for Nike, I think it's a generally good PE. Don't have 4 PE here, I think, but whatever. Again, I don't value my companies that I invest in. I don't value my investing thesis on just valuations like PE for PE, debt to equity and stuff like that. I look at the numbers a bit more, and I try to find an explanation for everything I look at. And if you're looking for strictly revenue is okay for Nike. I think it's okay. I mean, this is the 2025 FY25 and FY26 estimates. But if we're looking at 23 and 24, which we have, it's actual data, it's not an estimation, we had a very small growth. And yeah, that's problematic. We don't want small growth, we want a lot of growth from a company. But at the same time, if we dig a little bit deeper, first of all, we can see that the profitability, the net profit of a company like Nike has gone up a substantial amount. It's like 15%, something like that, which is a lot. In my opinion, it's a lot, especially if you're judging from revenue compared to profit, because that's kind of stresses out one thing. Nike has improved its costs, and if we look down, and if we are looking at quarterly results, so for example, if we are looking at May 24, we see that we have 6.9 billion in cost of goods sold compared to the same quarter last year when it was 7.2. So the cost of goods sold, even though the revenue went down a bit, the cost of goods sold went down a bit more, which is a good thing. The other good thing that I want to stress out, and we can look at also annual, but also quarterly. So selling, general and admin expenses and other operating expenses, we have almost 2 billion here, and we have 16.37 billion. So we have a reduction in expenses. So besides the gross profit, which is higher, so we have a higher gross profit, we also have lower expenses. So for a company like Nike, I think this is a very important topic. When you're in the entire world and you can't innovate that much, I mean, you can bring a new product, you can do something new, but you can't innovate as you have in technology, the technology sector. But you can reduce cost when it's possible, and this is what Nike has been doing. It has been reducing cost, and we get a higher net income of 5.7 billion. Also, if we look at Nike, and this is on Guru Focus. By the way, the website I was looking at earlier is FenChat. It's a nice website. You can also use a free version of it. But if we look now on Guru Focus, because it's also a very nice picture that it paints, from a cash to debt thesis, we're okay. We're in a very good spot. Not ideal. I would say that the spot we were like 10 years ago, it was better when we had lower debt, more cash. But judging from, well, the period that we just came from, I mean COVID, it's a bit normal to have what we have here. I mean, it has improved. The cash has gone up, and given the economy right now, I think Nike is still in a good position. Revenue has gone up constantly, consistently. Yes, we have a small bump right now. Don't have the paid version, so a very small bump up compared to last year. So from 51.2 billion to 51.336, not much. But at the same time, if we're looking at shares, we have constant share buybacks. We've had this for the last over 10 years, with a very small exception here. But all in all, Nike is doing the right thing. It's returning profit. It's returning money to the investors, either by dividends or by shares buyback, even in a kind of tricky environment like it is right now. So Nike, from this perspective, is really is looking really good. Also, if you're looking at the financial reports, I also want to underline this share buyback. This is for the entire year, $4.3 billion, 41.4 million shares. Just in this quarter, in the last quarter of May, ending May 24, we had $1 billion in shares buyback, 11.1 million shares. That's a lot. So Nike is doing the right thing. And also, if you're looking again at cost of sales compared to previous periods, we have let's say a better management of cost. We have a bigger gross margin, for 44.7 compared to 43.6. It's not much, I know. If you're looking like, oh, what's like 1.1%, not much, but for a company like Nike, it matters. And also we have a better management of cost going forward. So 42.4% of cost for SG&A compared to 34.1. So lower cost, a bit less revenue, 2% less revenue, but a way better cost management out of Nike, and this ended up with a bigger net income. So more profit for the company, more money staying in their pockets, which is again what we want. And if we go back to FinChat and go to their modeling tool, which is really nice, I really recommend it. I did some like playing around with the numbers, and this is my view for their FY25, so FY financial year, fiscal year 25, and going forward, I see a very small increase. So not as bad as 2024, because I see the Fed cutting rates at a point and this improving, so their situation improving, so just a 2%. But going forward, I think I see a bit of a spike in their growth for Nike, similar to the post-pandemic spike that they had. So this is kind of my thesis in terms of revenue growth. And I see like an exit multiple, because okay, you can look at the other numbers how I envision them. It's mostly median, the median that I found for each. What I thought of as an exit multiple in terms of enterprise value to free cash flow is like a 20. For Nike is extremely small. I think the smallest, the lowest it's like 18.4, something like that. This is pretty close to that, and I think it's a fair approach. We can even bump it up to like 22, 23, but let's just stick to this because this puts us in like a fair value territory right now. If we also see it from a perpetuality terms of the terminal growth rate, which I think it's like 3.5% is pretty accurate. Don't see it lower, don't see it higher as well. It's also implying that we are in fair value territory. So all in all, we are good with Nike. Yeah, it would be awesome to have like a lower price, to be like 70, 65, to get it with a discount like 10, 15%. I'm not sure it will go there, but for a long-term investor, I think this is a good approach. I think this is a good moment to invest for someone who's willing to wait 2, 3, 4, 5, 6 years. It will be okay. You will get like 2% dividends, judging from the amount that you get right now compared to the price of the stocks that you pay, of the stock that you pay. And going forward, I see improvements in their stock price, at least to like $100 at the point when revenue starts growing again at a better pace. And if they continue to be careful with their expenses, because that's very, very important. So from my perspective, Nike is in a fair value territory. It has a good dividend, it has good histories, it has good financial strength, it has good free cash flow, constant free cash flow. So it's in a good position. It has market dominance in terms of footwear and sports. It has a very good spectrum in the world. So I think Nike is in a good position compared to other companies, other competitors. And it's a steal right now. I see it as a steal. I see it as like an easy 25 to 30% in the next 1.5 years, plus the dividends that would put you like what, 30 to 35% in 2 years. Let's average it out to like 17%. That's a good return for a company, and I think it's a conservative approach that I'm taking with like this 25% growth. So I see Nike in a very, very good position. I'm not sure if everyone has this view of Nike, or at least look at it. Look at it because it's a very good company to have. So that's all from me. I hope you liked the video. I hope you want more. That's all from me. If you like the video, like, share, subscribe. That would help a lot, and see you next time. Bye bye.